Amazon, Google, Meta, OpenAI, these big tech companies are burning through billions in spending, yet the revenue coming back is barely a fraction of that. According to Sequoia, the industry will need to generate $600 billion in annual revenue just to break even on its total infrastructure costs. But energy costs are rising and retention rates are plummeting. Is there actually hope that AI can survive this airline trap like Warren Buffett once warned? Today, let's look past the hype and dig deeper into the AI balance sheet to spot what's actually hidden in the numbers. My name is Phoebe, and you're watching TradingKey. Before we dive in, just a quick reminder that this is for research and sharing purposes and does not constitute investment advice. Understanding the logic is always more important than the trade itself. First mover penalty in AI model training. Let's look at the hard numbers. The costs of training AI models are surging, and Deloitte suggests that AI is moving from the lab to the factory phase, triggering a multi-billion-dollar construction need for AI data centers. In the current cycle, pre-training a state-of-the-art model requires a capital outlay of at least $100 to $300 million, and that's just for the compute alone. This is the table stakes to stay in the game, yet it guarantees zero technical moat, though Wall Street is finally waking up to the first mover penalty. A pioneer spends hundreds of millions on trial and error, but a follower can use model distillation to replicate 90% of that capability for a fraction of the cost. In 2023, OpenAI's GPT-4 held the top spot for 10 months. By March 2026, Google's Gemini 2.0 Ultra held the crown for only 18 days before being overtaken. In a world where technical leads have a shelf life of 3 weeks, massive capex no longer warrants a moat. Instead, it's building a treadmill for competitors to follow suit. Why user scale is failing AI. Many investors believe a massive user base and high traffic volume represent a safe haven. In AI, however, that is a total illusion. The data flywheel is now broken. When millions of casual users ask an AI what they should have for dinner, those interactions provide near zero marginal value to the high-level logic and reasoning required to actually improve a frontier model. Now, scaling intelligence requires human experts and expensive synthetic data, which means having the raw user scale alone can no longer drive the model's IQ. Moreover, the costs of switching to another AI platform are remarkably low. RevenueCat's 2026 report shows the median annual retention for AI apps is only 21%, nearly 10 points lower than the 31% average for non-AI apps. This means 79 out of every 100 users churn within a year as they migrate freely between competing AI subscriptions. If your customer acquisition cost exceeds your lifetime value, a massive user base isn't an asset but a high-latency drag on free cash flow. Warren Buffett's warning to AI investors. Buffett once joked that if a capitalist had been present when the Wright brothers took their first flight, he should have shot them down for the sake of future investors. It's a grim punchline, but the data backs it up. From 1978 to 2010, the U.S. airline industry saw cumulative losses exceeding $50 billion. They might have changed the world, but they also incinerated capital. Today, with high fixed costs, shallow moats, and a lack of pricing power, LLMs are the new airlines. First, they revolutionize society while bleeding equity. Just as airlines connected the globe, AI is democratizing knowledge, but the core players are drowning in financial volatility. Second, the CapEx treadmill is relentless. Much like how airlines must constantly debt finance new aircraft to maintain routes, AI labs must also borrow billions for next-gen GPUs just to stay relevant. Third, there is no brand loyalty. Passengers hunt for the cheapest seat and developers hunt for the cheapest API. In fact, AI is economically worse. Airlines have a price floor dictated by fuel costs, but AI has near zero marginal costs. This means the price war can drop all the way to zero, leaving pioneers with nothing but massive depreciation. Who actually wins the AI war? Now, it all boils down to the final, most important question. Who is the real winner of this new AI phase? In a hyper-commoditized sector, profit always concentrates at the most rigid links in the value chain. Because of this, our strategy remains precise. Firstly, The suppliers. These are the ones selling the tools, like NVIDIA, for example. As long as this arms race continues, the lost profits of the downstream labs are essentially converted into capital expenditures handed over to this hardware giant. Secondly, the distributors. If competition among AI applications is fierce, the low-cost advantage is simply passed on to the consumer. This means only the distributors with gatekeeper power can retain the profits. Think of Apple with its 2.5 billion active devices, or Microsoft with its iron grip on enterprise productivity. They can simply wait for base models to become dirt cheap, integrate that intelligence into their existing operating systems, and reap the massive margin expansion driven by the tech. So, where are you placing your bets? Do you favor the suppliers or the distributors? Let me know your thoughts in the comments below. Thanks for joining me today. If you found this video helpful, remember to subscribe to TradingKey, give this video a like, and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.